budget shocks, policy uncertainty, slowing business investment, and a housing market trying to catch its breath. Meanwhile, the social and political landscape in the UK is shifting fast. If you're an investor, landlord, or business owner, it matters. Stay with me because this month's developments could define the shape of 2026. Welcome back. In our previous updates, we've been tracking cautious optimism returning to the market. Inflation was easing slightly, lenders were softening, and confidence was slowly creeping back. But November brings something different. We're seeing a new layer of political and economic pressure alongside structural shifts in migration, housing, and investment. These developments aren't just background noise, they influence real decisions for investors, landlords, and business owners. It's a month where economic output, property demand, rental markets, and government policy intersect in ways that ripple into 2026. So let's break it down and connect the dots, starting with the autumn budget and its aftermath. The autumn budget at the end of November didn't arrive in isolation. The uncertainty started weeks earlier, largely driven by leaks and speculation. Stories about potential tax rises, new wealth levies, and changes to high-value property surcharges circulated well before the Chancellor officially spoke. These leaks weren't just noise, they influenced behaviour across the economy. Businesses held off on hiring, new investment proposals were delayed, households postponed major purchases. Some individuals even adjusted pension contributions or delayed new ones in anticipation of possible tax changes. When the budget landed, it confirmed a mixture of intended and significant measures. Among the headline-grabbing announcements was the introduction of a new surcharge on homes valued at over £2 million in England, the high-value council tax surcharge. This will take effect from April 2028. Owners of properties valued between £2 million and £2.5 million will pay an additional £2,500 per year. The surcharge rises in bands to a maximum of £7,500 annually for homes worth over £5 million. While this directly affects a smaller segment of the market, the ripple effects are wider. Luxury property investors may reconsider deals, estate agents may adjust pricing expectations, and high net worth buyers may delay purchases until the full impact is clearer. Far broader in reach are the budget's moves to raise taxation on income derived from assets, namely rental property, dividends and savings, together with a continued freeze on income tax and national insurance thresholds. More specifically, from April 2026, dividend income tax rates will increase by 2 percentage points, the ordinary rate rising from 8.75% to 10.75%, and the higher rate from 33.75% to 35.75%. And from April 2027, property, i.e. rental income, will be taxed under separate property income tax rates. Basic rate 22%, higher rate 42%, an additional rate of 47% rather than general employment income rates. Tax rates on savings interest will increase by 2 percentage points across all bands. And in addition, the budget confirms another extension of the freeze on personal income tax and national insurance thresholds. As a result, as inflation and nominal pay increases continue, more people will be pushed into higher tax bands, a phenomenon often referred to as fiscal drag rather than a formal rate increase. These measures, the asset income tax increases, the surcharge on high value homes, and the threshold freeze, together signal a broader shift in the tax burden, away from just labour income and more onto wealth, property, and passive income streams. For everyday workers, the budget still matters, perhaps more than many realise. As wages rise slowly due to inflation or incremental raises, the frozen thresholds mean nominal pay increases don't convert to real gains. That reduction in real take-home pay squeezes household budgets, reduces consumer spending, and in turn depresses demand across the economy. For property investors or landlords, the changes have direct implications. rental income will be taxed more heavily, returns may shrink, and yield calculations must be revisited. For owners of high-value homes, the forthcoming surcharge changes the long-term holding cost dynamic. Taken together, the leaks, the budget itself, and the tax changes have created a fragile environment. The market remains operational, but growth is likely to be slower. Fewer buyers in the property market may limit short-term price appreciation. Landlords may reevaluate returns, and for many households, tighter budgets may increase demand for rental property as stepping onto the property ladder becomes harder. For investors or business owners, especially in property or buy-to-let, this underscores the importance of careful cash flow management, conservative assumptions, and strategic planning to navigate a more challenging fiscal environment. The autumn budget's tax measures are occurring alongside notable shifts in population flows that have implications for housing and rental markets. Recent Office for National Statistics data show that in the year ending December 2024, an estimated 257,000 British nationals emigrated from the UK, while only around 143,000 returned, producing a net emigration of approximately 114,000 people. Analysts note that this outflow is disproportionately concentrated among younger, working-age individuals, which could include entrepreneurs and highly skilled producers. Some commentators, including the think tank Resolution Foundation, have suggested that rising tax pressure is a contributing factor to this trend. At the same time, overall long-term net migration to the UK fell sharply in the year ending June 2025, dropping to 204,000 from 649,000 the previous year. And while total net migration declined, asylum claims have surged, with the Home Office recording 110,051 applications in the year ending September 2025, a record high. A significant portion of these claims arrived through irregular routes, including small boat crossings, accounting for roughly 41% of total applications. Analysts and commentators such as the Institute for Fiscal Studies have noticed that this combination of emigration by high earners and an increase in arrivals requiring support places additional pressure on public finances and social services. These population shifts have clear implications for the housing market. With fewer potentially high-earning British citizens remaining, the number of households able to enter the property market as first-time buyers may decline, which can slow sales activity and limit capital appreciation. Meanwhile, new arrivals who are not immediately in a position to purchase property contribute to rising demand for rental and social housing. The National Housing Federation has highlighted that growing demand for rental accommodation, particularly in areas with high asylum intakes, can push up rents, making it increasingly challenging for working households to access both home ownership and affordable rental options. For property investors, these dynamics can create both opportunity and risk. The combination of weaker demand in the sales market and stronger rental demand can support higher rental yields, potentially benefiting landlords who already hold property. However, investors face challenges, including historically high interest rates, which increase the cost of financing, and intensified competition from institutional investors and large real estate funds, which are cash rich and actively acquiring property. For example, recent reports from Knight Frank indicated that institutional buyers have accounted for a growing share of UK residential acquisitions, particularly in metropolitan areas, highlighting the competitive environment for private investors. The overall picture, however, points to a market where demographic shifts, fiscal policy, and housing supply demand dynamics intersect in ways that both constrain home ownership for many and present calculated opportunities for property investors. The output for the UK economy is becoming more fragile as several headwinds converge. Weaker business investment, higher taxation and cost pressures, and strain on the construction and development sectors are all weighing on output, productivity, and future growth potential. According to the Office for Budget Responsibility, the OBR, the real rate of return on capital is expected to fall from around 12.5% in 2022 to roughly 10.75% in 2026, reflecting weaker profit growth and higher cost pressures for firms. At the same time, the OBR warns that business investment, which fuels capital spending, hiring, and expansion, is likely to remain subdued through the forecast period as firms contend with elevated borrowing costs, squeezed margins, and uncertainty around policy and demand. This deterioration is already visible in the construction sector, a critical engine for housing supply and infrastructure. February 2025 data from the S&P Global CIPS UK Construction Purchasing Managers Index showed a headline drop to 44.6, the steepest contraction in output since May 2020. Residential building fared worst. Its sub-index plunged to 39.3, marking the fifth straight month of contraction and the weakest reading since 2009. Firms cited weak demand, higher borrowing costs, and a scarcity of new work replacing completed projects as the main causes of the slump. As output, investment, and construction activity slow, broader productivity growth also comes under pressure. With less new building, delayed projects, and fewer upgrades to commercial infrastructure, the supply side of the economy is constrained. For housing, both residential and commercial, that means fewer new units coming onto the market, limiting supply growth and exacerbating imbalances between supply and demand. For markets dependent on consistent rental demand, commuter belts, regional towns, cities with universities, hospitals, or logistics hubs, the slowdown in supply growth may raise the value of existing rental stock. As new builds stall and fewer starter homes reach the market, demand will increasingly shift towards rental accommodation. That creates what could be a structural rotation away from home ownership growth towards long-term rental demand. For property investors, this environment presents a strategic recalibration. Rather than banking on quick capital appreciation from rising house prices, the emphasis may shift towards cash flow. Reliable rental yield rather than speculative price growth may become the safer bet, especially in areas with stable employment, local services, and limited new development. That said, risks remain. Higher interest rates continue to raise financing costs, eroding the attractiveness of buy-to-let acquisition. Additionally, firms are competing with large housing providers and institutional investors who are cash-rich and better positioned to procure properties. As a result, individual investors, especially smaller-scale landlords, may find it harder to source value deals, forcing them to be more selective and cautious. Even in a market weighed down by slower investment, higher taxes, and constrained supply, opportunities exist for those who are prepared. Uncertainty tends to freeze many players on the sidelines, creating conditions where disciplined investors with liquidity and long-term perspective can access assets at favorable prices. Properties with strong rental potential, whether residential or undervalued commercial stock, are particularly attractive in this environment, as stable income becomes more valuable than speculative capital gains. Success in this climate depends on careful location selection, prioritizing areas with consistent rental demand, and maintaining strict financial discipline. Investors who can adapt to the structural shifts in supply, demand, and policy are better positioned to benefit from these dynamics. Flexibility, foresight, and preparation will separate those who thrive over the next 12 to 18 months from those who struggle, turning market uncertainty into a strategic advantage. At its meeting ending the 5th of November 2025, the Monetary Policy Committee decided, by a close 5-4 vote, to hold the bank rate at 4%. 4 members favoured the modest cut of 25 basis points to 3.75%. In its November monetary policy report, the Bank of England judged that consumer price inflation has likely peaked and signalled that disinflation appears to be underway. The committee noted easing pressures, slower pay growth, a cooling in services price inflation, and emerging slack in the labour market as demand softens. CPI data for October 2025 supports that view. Inflation fell to 3.6%, down from 3.8% in September. In underlying terms, core inflation also eased slightly. Additional downward pressure on inflation is expected as higher energy price effects from last year drop out of the comparison and services inflation moderates further. Several independent analysts and economists are interpreting these trends to mean that the Bank of England is likely to deliver a small rate cut at its next meeting scheduled for the 18th of December 2025, provided inflation trajectory remains favourable. The prolonged period of elevated rates has imposed real pressure on households, especially homeowners with mortgages sensitive to interest rate movements. A modest cut now could relieve that squeeze, reducing the risk that vulnerable homeowners lose their properties if the rate stress continues. Moreover, with inflation easing but still above the Bank of England's 2% target, and with signs that inflationary momentum is fading, the conditions seem increasingly supportive of a cautious reduction. Finally, cutting rates now might help restore some confidence among consumers and businesses. Lower borrowing costs could support demand for housing and investment at a time when uncertainty and fiscal burdens risk suppressing growth. However, inflation remains well above target and certain price pressures, especially in food and non-energy services, continue. That uncertainty likely contributed to the narrow hold decision in November. Some members of the MPC may argue that sustained disinflationary momentum needs clearer evidence before endorsing further cuts. Others may want to see how the new fiscal measures introduced by the government play out, how tax changes affect demand, wage growth, and price pressures before lowering the cost of borrowing. November has been a month of political tension, policy reform, and cautious market behaviour. The autumn budget and migration changes injected uncertainty. Business investment is softening, buyer demand is subdued, and yet rental demand and institutional interest remain robust. For investors, landlords, and business owners, success in the coming year will depend on careful planning, conservative strategies, and a clear focus on sustainable cash flow. If you found this update useful, share it with someone else who is keeping a close eye on the market. I'd also love to hear from you. Are you adjusting your strategy to this new reality or waiting for the market to get easy again? Thanks for watching. As always, I appreciate for being a subscriber, and I'll see you again on the next one.